What's up, traders? I'm going to keep this video very short and very simple because today we are going to talk about new day opening gaps, and more specifically cash gaps or gaps back to settlement. If you are a futures trader, you need to be really aware of the cash gaps because they won't be obvious on your screens and they're very important levels. So stick with me right here as I explain them to you and show you how easy they are to mark out and how helpful they can be for key levels on your charts. Before we get into it, you can do me a massive favor. Help me show up more in the YouTube algorithm. Hit the like button underneath right now. If you haven't already, hit subscribe. So many of you watch my videos and still don't subscribe. And if you want to see more content from me, just post underneath what you would like me to cover in the future. But enough waffling, let's get into the charts. Now, if you have been a futures trader for a while, you will understand that the market closes at 5 o'clock New York time, Eastern time, okay? So the true market closes at 4 o'clock and then you have an hour for settlement, an hour for everything to go through, and then it has an hour-long break until 6 o'clock when it reopens. And during that period, you can have new day opening gaps. And this gap will appear and can be different ranges each day. So from here, we have a new day opening gap, okay? This was the gap from the end of Wednesday's session until the start of Thursday's session. I know it says Wednesday, but it's because the session starts at 6 o'clock on Wednesday. It's still Thursday's session. And it's really important that you pay notice to these gaps because, as we know, gaps present imbalances in the market. They are areas where volume is non-existent or very low in liquidity, so we have to pay attention to that. And I can give you a good example here just by pulling this volume bar up. So if we have a look here, between the start of the New York session, which is 9:30 right here, till the close on the imbalances at 4 o'clock, we have a huge amount of volume. But you'll notice either side of that, volume is much lighter. These are the overnight ranges. This is the Asia range and the London range, and the same here, Asia range, London range, until we get the 8:30 open, the pre-market open, when you are able to start trading stocks at your desk, and the news comes out, and of course back into the 9:30 until 4 o'clock close. Now the spikes at the end, these are end of day imbalances. This is where stocks need to be paired off, where there are imbalances in the market, which is why you have these huge spikes in liquidity. You also have the same at the beginning of the market. But there is a big but here. As I have just told you and explained, most trading takes place between 9:30 and 4 o'clock, which means you need to be paying very close attention to those points because that is where volume is occurring. That is where traders, big institutions are at their desk. That is when they are placing options. That's when they're having their hedges. That's when they are using the most amount of contracts. So you need to be aware of those levels because anything in between that, as we talked about, is very light in volume, which means the structure often isn't respected in the same way. The easiest way to look at that on a futures chart would be to move it from extended or electronic into regular trading hours. And you will notice here the gap between Wednesday and Thursday is nowhere near this level down here when we're looking at the New York range. In fact, the new day opening gap comes from this close, 4 o'clock close, not 5 o'clock, all the way up until the opening print. And you will notice it left a very large gap. So what the market was looking to do today was a gap and go. We had a pullback into the gap, not a full fill, but a pretty decent fill. It actually held an Asia high. If you watch the video I put out yesterday, I'll post a link underneath on key levels. That is why it held it and moved to the upside. And once we had this partial fill of the gap, we could continue for upside pressure. So understanding the cash gaps are really key. Now, if this is too much to put on one chart, and if you have the luxury of having multiple monitors, another easy way to look at this would be to simply look at the ETFs, because the ETFs are where most of the volume is taking place. So we can look at that right now. Heading over to the Qs then, and you will see right here is your new day opening gap. Again, the same structure, all right? It is replicating everything that is happening on the NQ. And of course, if you're trading the ES, look at the SPY. That's your ETF for the SPY. Now, if you don't have this on regular trading hours, you can have it on extended hours. The same gap will apply, but you now have the after hours and the pre-market print. So these are other levels you can pay attention to. When we start to break outside of the pre-market high, this level right here was your pre-market high. All right, that is a very, very obvious breakout long, okay? A very clean, obvious breakout long. All the time we're holding pre-market lows, all the time we're holding this trend right here, we can think about upside pressure. So don't be scared to use another chart and make sure you understand the cash gaps. They are not the same as the tiny new day opening gaps, which you get when you're in extended hours on your futures charts. There is a big difference. You want to be knowledgeable of where the market is really opening and really closing for those imbalances based on cash, because that's where the volume takes place. That's where structure is far, far more likely to be respected. So a very short video there, but hopefully it's answered those questions which some of you sent me on the last video. I'll be back same time, same place next week. Until then, do me a favor, hit that subscribe button and use hard stops.